In this video, I want to do a review of a really good book that I read, and this is actually this book right here, The Little Book of Common Sense Investing, The Only Way to Guarantee Your Fair Share of the Stock Market by John C. Bogle. And before I even talk about this book, let me say that this book is actually a really good read, and I think you guys should get a copy of this book. I'll also be leaving the link down below to this book, but just in case you want to have an idea of what's inside the book, I'm going to be giving you guys a short summary today, and again, I think this is a really good book to read about investing, and this is something that you can go back to over and over again if you're an investor. Now, by the way, guys, just in case you didn't know, and you probably didn't, but John C. Bogle, the writer of this book, is actually the founder of the Vanguard Group, and yes, that same Vanguard Group that has all those popular low-costing ETFs that everyone loves so much, such as the popular Vanguard S&P 500 ETF. So this book was actually written by someone who knows what they're doing, and it has a ton of value. If you guys didn't know, John C. Bogle is actually the person who is credited for creating the first ever index fund. So if you're an index fund investor, you should actually be thanking this guy and also this book right here. Now, before we get into the main points of this video, just a quick reminder, if you are new to the channel and this is the first time you're coming across and seeing me, my name is Eann, and on this channel I talk about ways to make money, ways to save money, I talk about ways to invest your money, I talk about bank accounts, credit cards, crypto, and just about everything to do with personal finance really. So if you like these videos and you like these types of topics, be sure to give this video a thumbs up. I'll really appreciate it. It's 100% free, it won't cost you anything. Also, be sure to subscribe with the notifications on, and that way you never miss any of the future updates of when I post new videos on this channel. Now, the very first point in this book is that the stock market is actually a giant daily distraction to keep investors focused on the day-to-day movements of the market in an effort to time the market. Now, this distraction takes investors away from focusing on the actual important things that they should be looking at, which is the long-term outlook and the gradual long-term growth of the stock market. So for example, you're watching this one particular stock and every day it's either up by $10 or $100 or down by $10 or $100, and the price is always fluctuating on the daily. However, the long-term picture is that this particular stock is increasing in value by 1% every single month, for example. So because you're so focused on the everyday movements of this one particular stock, you're trying to find the best time to buy and sell, you don't see the long-term picture, and so you don't invest the right way, and this way you actually get left behind while you're being distracted by the day-to-day fluctuations in the market. Now, the book goes on to say that instead of focusing on day-to-day fluctuations in the market, you should purchase a small slice of every single company in the market, hold on to them for the long term, and this way you can benefit from the giant earnings and dividends from some of these massive corporations. Another good point that this book went on to make is that whenever you have a problem and you're trying to find a solution, you should always go with the simplest solution. So don't overcomplicate things, and in terms of investing, a simple solution to investing and making a lot of money would be to invest in a broad total stock market index fund, which gives you a slice of just about every single stock for a low cost, and this is why John C. Bogle went on to create the first ever index fund in 1976. Now, to prove that his line of reasoning works, he created the first ETF in 1976. It was the first one ever. This is the Vanguard S&P 500 Index Fund, and from 1976 to 2016, if you had invested $15,000 in this index fund, you'd have almost $920,000 in 2016. So during this period of time, there may have been many market crashes and many market rallies. However, the purpose of this index fund was never to focus on the short-term fluctuations in the market or the day-to-day movements, but to look at the long-term picture and get investors to invest in this broad index fund. Now, the book also brings out a very important point, and this is that you don't want to be winning with the stock market, but playing a loser's game. So as an average investor, you want to get the average market return even after you've subtracted the costs and fees associated with investing. And for example, you can go to some brokerages and you'll try to invest and they'll charge you a bunch of fees, and so you may get 10% in returns every single year, but then after fees and service charges, you're only making 1 to 2% in returns per year. So you're not actually making any money, you're actually losing. Now, in the book, it gives you some examples of how this works. And so, for example, let's say you had $10,000 invested over a period of 50 years and you got 10% in returns every single year, and you never added anything to that investment. at the end you'd have around $300,000. Now from $10K to $300,000 sounds good. However, if you had a 2% investment management fee, only 2%, just a small 2% fee, this nearly $300,000 ending balance would be reduced to $114,000, which essentially is wiping out around 66% of the money that you could have had. So even the smallest of active management fees can weigh you down in investing, and you don't want to be winning with investing but also playing the loser's game by paying all these fees. So the main point here is that you should always focus on the lowest costing broad index fund, and this is one of the reasons why Vanguard's ETFs are usually some of the lowest costing. Now the book also goes on to talk about the behavior gap and where investors use emotions, and these emotions lead to bad decisions. For example, people are always usually trying to purchase the most popular or hottest stocks. So for example, if Amazon is booming, then everybody wants to buy Amazon because Amazon is booming, and so this causes them to buy in at the top of the market, and then sooner or later the stock falls and then they lose a lot of money. This happens because fear causes them to sell when that investment falls really low or it bottoms out, and so they miss out on the opportunity or the next potential market upswing. Now this book goes on to say that if you're trying to invest in the latest tech funds or the hottest stocks or the most popular stocks at any particular time, then it is very likely that you're going to buy at the peak and you're going to lose a lot of money, as opposed to you just investing in a broad market index fund, because stocks that are top performers today are very unlikely to be top performers in the next 10 years. So back to the psychology. If you invest in an index fund, it removes the distraction of you watching the stock market every single day. It removes the emotions involved that you would experience with people talking about the latest or hottest stocks right now. And so it removes all the distraction and all that stuff, so you can simply invest and focus on the long-term growth of your investments. Now, the book also went on to make a point that managed funds, or less than 2 in over 350 managed funds, will actually outperform the market, and this is less than 1%. So John C. Bogle says that instead of looking for the needle in the haystack, just buy the entire haystack, and that solves that problem. He also goes on to say that the best performing funds today will most likely not be the best performing funds tomorrow, and newer funds or newer stocks may come and outperform whatever is booming today, and that is why you don't want to go out there and try to time the market every single day. You don't want to go out there and try to pick stocks or actively manage your investments. Instead of doing all that work, instead, go and get yourself a low-cost, broad market ETF and invest for the long term. So you want to focus on a long-term compounding and investing in the stock market, and you also want to have as little as possible cost associated with investing. And this is just a short summary of this book. There is a lot of info in this book, a lot of calculations, a lot of examples, a lot of charts. And if you are interested in investing, or if you're currently investing in the stock market and you've never read this book, I think you should definitely get it. It's on Amazon. It costs maybe 10 to 15 bucks. And I'll leave a link down below to it, and I think it was a really good read, and this is something that you should really read for yourself as well. So drop your comments down below. Let me know if you've ever read this book before, if you've read any similar books to this that were really good that you'd like to share with us as well. And as always, all the best with investing and making a lot of money. Be sure to give the video a thumbs up if you like the content. Don't forget to subscribe with the notifications on. And if you ever want to talk to me one-on-one, you can message me on Instagram. That link is down below in the description as well. And if you're looking for a platform to invest in, be sure to check out M1 Finance. You can also get $50 for free if you use my link. And with all that said, thank you guys so much for watching. All the best, and I'll see you very soon in the next one.